Morning, good afternoon, good evening, wherever you're in the world. Thanks for joining Financial Statements at the Peterson Institute for International Economics. I'm Nicolas Véron. It's a particular interest for me to discuss European banking supervision, and I couldn't think of better speakers, of course, for that than the ones we will hear today. Claudia Buch studied economics at the University of Bonn. She got her degree there in 1991. In the meantime, she also had a Master of Business Administration at the University of Wisconsin, Eau Claire. She then got her PhD at the University of Kiel in 1996 and worked there at the Institute for the World Economy, known by the German acronym IFW. She became a professor at Kiel in 2002. She led at IFW the research field for financial markets in the early 2000s, and then she moved to other German universities in 2004 at the University of Tübingen, in 2007 at the Center for European Economic Research, known by the German acronym ZEW, in Mannheim. In the meantime, Claudia started working a lot on public policy. In 2004, she joined the Economic Council of the Ministry of Economics in Germany. She became the chair in 2008. In 2011, she became a member of the Scientific Council of the European Systemic Risk Board in Frankfurt. The next year, she joined the German Council of Economic Experts, the Sachverständigenrat, where she stayed for 2-3 years. She's also been in advisory position in the German Ministry of Finance, at the European Commission, and eventually, of course, this became a full-time occupation when she joined the Bundesbank in 2014 as a vice president in charge of financial stability. And last year, she was appointed the chair of the Supervisory Board within the European Central Bank. She will explain the organization, which is a top job in European banking supervision since the introduction of banking union a decade ago, a job she took on from Andrea Enria, who also spoke in this series in the past on the 1st of January of this year, 2024. Karen Petrou studied political science at Wellesley College at MIT. She got a master's from University of California, Berkeley in political science, and then she worked in the financial industry at Bank of America for a number of years from 1977 to 1985, when she founded Federal Financial Analytics, which is a consultancy which is kind of one of its kind, very frequently quoted in public and media debates in the US on anything financial regulation, and especially banking regulation and supervision, in policy debates, in Congress, in a number of course, policy organizations. Karen has authored a book on the Fed, which was published a couple of years ago. She has sat on a number of bank boards, but also on a number of nonprofits, and I will mention 2 nonprofits she's engaged with at this point, the Foundation Fighting Blindness and the Fidelco Guide Dog Foundation. With that, Claudia, over to you.
Thank you very much, Nicola, and thanks for having me here in this series. I've been watching it many times, and I'm always learning a lot from it, and I hope that also and the viewers will learn something from our conversation. I'm also very much looking forward to discussing the issues with Karen. So I've brought a presentation. Let me share it and hope that it's working. This is it. Yeah. So as you see on the slide, I will be talking about how we have currently decided to reform European banking supervision. So that sounds very broad. Of course, we leave the main architecture in place, but we have discussed in the Supervisory Board that we need to draw lessons from the first 10 years of the SSM, so the single supervisory mechanism in Europe, also responding to evolving risks. So this is the title of this presentation: Evolving Risks, Evolving Supervision. So basically, I want to cover 3 questions. First, give an overview to the audience of how banking supervision is organized in Europe. I will do this very briefly, how the risk environment has evolved, and then I will go into some more detail about how we are responding in terms of reforming our supervisory structure. So how is banking supervision organized in Europe? Let me first give you a bit of a timeline, because the single supervisory mechanism is actually part of the banking union that was established 10 years ago in response to the financial crisis and, of course, the European sovereign debt crisis. So on the bottom of this timeline, you see the shocks that have happened in the meantime, and actually also since the establishment of the SSM, there have been shocks, obviously. There has been the COVID pandemic, the Russian invasion of Ukraine, the energy crisis, the inflation shock, and also in March 2023, of course, the turmoil in international banking markets, from which we all, regulators, supervisors, have drawn a lot of lessons. But already before, as you can see in September 2022, it was decided by Andrea and Ria that you've just mentioned to commission a report of an independent expert group on the SREP. And this is an acronym which I will explain in a second. So that's basically our supervisory review and evaluation process. So last year, the report was published, and then, as I've said, we decided this year in the supervisory board how to reform supervision, and this will be phased in over a 2-year period. Now, I mentioned the SREP. So this is basically our supervisory review and evaluation process, performing a comprehensive assessment of risks and controls in the bank. So it's basically starting from 4 questions. The first is the business model of a bank viable and sustainable? So we all look at all aspects of banks' business models. The second, are risk management and governance adequate? I think this is certainly a lesson that we've taken away from the turmoil on last year, that very often the root causes have been known for quite some time, also for the supervisors in terms of risk management and governance when we have banking crisis. But then these frictions are exposed by macroeconomic shocks. So that's why we pay quite a bit of attention to risk management and governance. The third, I mean, this is the core of banking supervision, obviously, is the capital position at risk, and then is the bank exposed to liquidity and funding risk. So these are the 4 key questions, the 4 issues we look at. Then we come to an overall supervisory assessment. And then, of course, we take decisions in terms of qualitative supervisory measures. These can be, for example, related to governance, quantitative liquidity measures, and also quantitative capital measures, of course. So this process has been set up over the past 10 years. It's working well. So when I'm saying, or when the supervisory board said we reform this process, is not because it's not working well, but it's rather complex and it can be improved. And I will show you how in a minute. But before, let me say a bit more of how we organize supervision in Europe and what was actually decided 10 years ago. So what was decided is to move the supervision over significant institutions. So that's what you see here on the left-hand side, under the direct supervision of the ECB. So in that sense, the national supervisors were giving up power to the ECB, to the European level. But at the same time, there's many areas where we closely cooperate with the national supervisors. So first, when we do the direct supervision, this is done through the joint supervisory teams. Here we also have colleagues from the national competent authorities. So the lead of this team is always from the ECB, but there's national supervisors contributing. Then for the less significant institutions, smaller and mid-sized banks, we have an oversight function, but the supervision is conducted by the national competent authorities. And then, of course, we come together in the supervisory board and take decisions collectively with the national competent authorities. In the end, all decisions have to be taken by the governing council of the ECB, where, of course, the different countries are being represented. So it's, if you want, direct supervision over the significant institutions, at the same time also cooperation within the system. And I'm happy to go into some more detail if there's interest. Now, this is how the supervisory mechanism has been set up. But of course, in the 10 years that it's been operating, the risk environment has evolved. So let me first show you where we stand in terms of risk and resilience, just picking out 2 indicators. Of course, we have many more, and then also say how we respond to changes in the risk environment. So what you see here is clearly that's a pattern we also see for banks internationally, that the capital ratio of ratios of European banks have increased, both measured by the risk-weighted ratio CET1 and also by the leverage ratio. Non-performing loans have been declining over time, starting from an average measure in 2015 of around 7.5, and now we're close to 2%. But for some countries, of course, the reduction in non-performing loans was much more drastic. What's interesting to see, maybe it's difficult to eyeball in this graph, but there's a slight uptick at the in the current period that's to some extent driven by commercial real estate. So we do see, of course, the weaker growth environment also being reflected in non-performing loans. But what's also interesting to see is that during the COVID pandemic, we did not see an increase in non-performing loans, despite having a large shock to GDP. And that, of course, has to do also with the measures that have been taken to prevent corporate insolvencies. Likewise, liquidity ratios have improved over time, as you can see here with the liquidity coverage ratio and the net stable funding ratio. So this is all good. This is good news. But of course, we also have to consider changes in the external risk environment. So we basically, when we decide on our supervisory priorities, we start from the broad global trends, the new macro financial environment, geopolitical risk, climate and environmental risk, and structural changes related to digitalization, demographic change. And from those, we derive our priorities: strengthen resilience to macro financial and geopolitical shocks, accelerate remediation of shortcomings in governance and climate and environmental risks, and also make sure that the banks can deal with the challenges, of course, also opportunities, but also challenges of the digital transformation, and have robust operational resilience frameworks. So this is how the risk environment has changed, how we respond in terms of our priorities, but we're also responding in terms of how we conduct supervision and how we also free up resources and time to focus on the relevant risks. And this is very much driven by the report we received from the independent experts that I mentioned at the beginning. And the group basically noted progress that the SREP, so our supervisory process, has helped to increase the resilience of the European banking sector, also to promote a level playing field. But at the same time, they also pointed for the need for improvement in terms of a recalibration of the SREP, making it more efficient, more effective, and also more intrusive. And that's what we have decided, of course, not only based on what the independent experts said, but also based on our own judgment and internal discussions. So we basically have 6 objectives with the reform that we have decided upon. And I would like to walk you through these 6 objectives now in the following slides. The first is focusing risk assessment. So this is something actually that we started already in 2023, and this is now gradually rolled out. So we have a risk tolerance framework acknowledging that not every risk is of the same relevance for every bank in every year. So the teams that do the supervision prioritize risk assessment, and they also have the opportunity to spread their risk assessment and their work over several years. So if they find that a certain risk is not relevant in a particular year or needs more time, then they can also phase it out over a period of 3 years. And they don't, I mean, if there's no material change in risk, they also don't need to update every risk assessment in every year. So that's called a multi-year assessment. The second objective is to better integrate the different supervisory activities that we're doing. So we're doing stress tests, we're doing horizontal thematic reviews, deep dives, on-site inspections, on-site supervision, obviously, and also internal model assessment. So we integrate all these activities in the sense that they all contribute to the decisions that we then have with regard to the banks, but we want to integrate them more so that they're also more, that it's easier to communicate also to the banks how different elements of these activities fit together, so that we also have a clearer planning, not only for us but also for the banks. The third objective of this reform is to use the full supervisory toolkit and moving up the escalation ladder faster to ensure findings are being remediated, are being addressed. So this is really, as I said earlier, the lesson learned, I think, that all supervisors took from the crisis last year, that of course we have to do our risk assessment well, then the next step on the escalation ladder is to do moral suasion. So explain to the banks why we want certain findings to be remediated. Then we can issue non-binding recommendations to our expectations. But in the end, it very often requires binding requirements or limitations such as capital requirements, or even more intrusive enforcement measures and sanctions, including periodic penalty payments, which we have in our toolkit, but so far have not been used a lot. So we escalate more. And I think in the end, it also brings more clarity to the banks what we expect and how we want findings to be remediated. The fourth focus of the reforms is enhancing communication by streamlining our SREP decisions. So clearly, supervisory communication to the banks needs to be concise and timely, but very often the SREP documents, of course, they're also legal documents that need to be legally sound, are quite long and complex. So we're working on focusing these SREP decisions and also conveying them earlier in the year so that there's also more time for remediation. We're also working on an improvement of our SREP methodology, so making our methodologies more stable, which would then also allow focusing on newly emerging risks. So basically what I've shown to you before, the SREP decision, of course, there's a lot of methodology behind it. How do we come from the four risk areas that we focus upon to the quantitative capital requirements? So this is the so-called Petrou, the Pillar 2 requirements methodology. So we're working on this and we will publish more at the end of this year. And then we're using a lot of, and that's the final step, we're using a lot of IT systems, data analytics to increase our efficiency, to save time on routine tasks. And again, in the spirit of focusing on the most relevant risks and becoming more efficient. For the sake of time, I don't go through all these elements here, but we can, of course, come back to them. So all in the end is targeted towards allowing supervisors to become more effective, to more effectively and efficiently respond to evolving risks. If you consider what good supervision is about, it's really about having a critical mindset, doing a sound analysis of microeconomic and macroeconomic risks like we've been seeing before, following up on findings that are not yet addressed. And this is something that takes time also for our supervisory teams. At the same time, and maybe that also broadens a bit to the discussion we can have about policy and regulation, we need to respond to evolving risks. So we need strong supervisory and regulatory standards. We need to ensure that there's sufficient operational and financial resilience of banks given the new risk environment. And of course, that I haven't talked about yet, but there's risks outside of the banking sector that need to be addressed. So a lot on our agenda, and we certainly believe and hope that the reforms that we've decided upon give more time to do exactly what you see on this slide. So let me stop here and thank you very, very much.
Thank you so much, Claudia. There's so much to unpack from here, also in view of what happened in the US and in Switzerland last year. I have a ton of questions, not least because I just published a long study of European Banking Union, as you know, but first, Karen.
Oh, that was indeed a fascinating discussion, and I learned a great deal. To speak about the United States, and I think there'll be some important comparisons and contrasts. Obviously, we had a severe banking incident, I think is the polite word, declared a systemic crisis last year in March of 2023, followed by another major bank failure in May of last year. The Federal Reserve Board and the Federal Deposit Insurance Corporation have since, as they promised Congress they would do, and as they are also required by law, they have issued what I would call autopsies of these failures. And they're useful timelines of what happened, and I think more distressingly of how much was missed. And in fact, what I find the most discouraging reading those reports is how little of what we learned the very hard way in 2008 has been corrected since. We've obviously added many important prudential standards, capital liquidity, risk management, efforts at resolution, and so forth in the United States and, of course, in Europe. But those are meaningless if they are not accompanied by supervision. And here we see exactly the same pattern. I recall after 2008, my firm was retained after that crisis, and we had access to numerous confidential supervisory reports of many large failed banks. And what you see over and over again is a pattern of supervisors being captive, or more politely cautious, certainly fearful of bringing problems first to their own manager's attention, and then to that of first the bank's senior management, and then of the board. They go to the board says essentially, well, that's a surprise. We'll certainly look into that. The supervisors wait 6 months or so, come back to the board and say, well, could you tell us how you've done? And the board earnestly says, well, we're really working on that. And the supervisors say, well, please do your best and hurry up. And so it goes until, of course, it's too late and the banks are irremediably harmed and unfortunately often no longer resolvable. And you see that again at Silicon Valley Bank, Signature Bank, First Republic Bank, and the small bank, Silvergate, that helped to spark the crisis, as is often the case. It's not the systemic institution or even a significant incident that sparks a crisis, but the markets were on edge. They know a lot, they didn't like a lot of what they saw, and they took fright. So what does one do? I think first and foremost, looking hard at the US supervisory edifice, we need to think about how lethargic and bureaucratic it's gotten. The IMF has done a quite interesting review of bank supervision around the world in the wake of the 2023 crises. And one of the failings it urges nations to repair is the lack of sufficient funding for their supervisory agencies. We don't have that problem here, nor do we have a problem of political independence, because the agencies, the Fed, the FDIC, and the third federal agency, the Office of the Comptroller of the Currency, are all self-funded, not required to be funded by the Congress. And they're essentially funded to the extent they wish out of a variety of revenue sources. To the best of our knowledge, the Federal Reserve and FDIC have about 5,300 supervisors, as well as all the attendant supervisory analytical personnel. We don't know how many supervisors the FDIC has because it has not disclosed these data, nor do we know the supervisory apparatus of the Bureau of Consumer Financial Protection, which is a very significant agency in the United States, nor of the state financial regulatory agencies, which govern many of the very largest banks, as well as thousands of small ones. So I think it is safe to say it is large. And large organizations, particularly governmental ones, are prone to lethargy and bureaucracy. And we see that. I think this accounts in part for the fear we see, the check the box mentality that was evident before 2008 and again before 2023. All of the number of hoops supervisors must jump through before they take any mandatory action, and their reluctance to do so. Now, one of course recognizes that supervisors need to be cautious with enforcement, but the longer they wait, particularly in material failings, the worse the situation gets. And a significant problem the banking industry has pointed to, and I think there is good evidence for, is that the supervisors are often so preoccupied by relatively minor deficiencies that they miss glaring major problems. So I really believe we need to slim down, hone the structure, the reporting. The function of our supervisory agencies needs a review, not to make it incapable, incompetent, under-resourced, but to make it lean and, where necessary, mean. I think greater public accountability will help a great deal. When I testified before the US Congress in 2001, after what had been the largest bank failure since the 1980s, I called for public disclosure of the ratings, so-called CAMELS ratings, and the like-kind ratings for bank holding companies that the United States has long used. I really do believe in these. Public disclosure. I think it is vital to hold the agencies accountable. We see again in Signature and at Silicon Valley Bank that these were highly rated banks until right before they failed. And that is, of course, far too late. Rating agencies, of course, similarly rated these banks well until the banks failed. The reason the banking agencies have been loath to publish their rankings is presumably because they fear the markets react to that. But I really think some healthy market discipline would be a very good thing. Right now, with all this opacity and secrecy, markets are prone to panic and flight. And I think it would be very helpful for the market to see trouble, and even more importantly, much more importantly, for bank CEOs and boards to know that if they fail to remedy supervisory failings, they won't be the only ones to know about it. We need, I think, considerably more market transparency. These are remedies I think would help to make bank supervision good. But I also think we need to be sure that lean, mean, transparent bank supervision is just. The banks have been calling for an appeals process. Legislation is pending to force that. There's a lot to be said for that, as long, and this is an important caveat, as long as it's not another reason for caution, delay, and check the box mentality of the banking agencies. We need ability for banks quickly to bring protests to senior agency personnel and have these resolved. I kind of like the policing model here, and I know it's not perfect, where the function is first and foremost to get dangers off the streets, using probable cause and due process without discrimination, and then a quick right of judicial appeal, followed by sure and certain punishment. Now, of course, that's not perfect, but it's better. And it works a great deal of the time. And that's what I hope we are soon able to move towards in the United States. We really, really don't need to be doing this all over again anytime soon. I fear if we don't take quick action, we might. A recent Office of Financial Research report says we have 519 vulnerable banks in the United States due to a combination of commercial real estate, unrealized losses, and large reliance on uninsured deposits. And we know from a recent Federal Reserve Board study that 22 banks experienced acute viral deposit runs at the height of the March crisis. How many of them would have failed along with Silicon Valley and Signature had the systemic designation not been put in place over the weekend? We will never know. But we do know we need to do something about bank supervision so that it is far more vigorous and effective here in the United States. Thanks very much.
Thanks, Karen. I cannot help asking first question to you, actually. On the face of it, and I know there's no place for complacency here, the supervisory failings that you reminded us of in the US didn't happen in the exact same way in the Eurozone. And actually, the Eurozone banking system is larger than the US banking system by total assets. Is there any debate in the US on lessons that may be learned from the European experience, or is that completely a non-question?
I think it's a difficult question. One of the issues we've had here, which I think is different than the European Union, is supervisory policy collides with merger policy. We certainly saw that both Silicon Valley Bank and Signature Bank were the result of rapid fire, ill-advised bank mergers, where the banks grew bigger and lost whatever risk controls and internal discipline they had behind. And the banking agencies, for all they're now talking about a very strict, limited, if any, bank mergers, up until 2023, we're all for regional bank consolidation, regardless of the absence of internal operational capability.
Basically, no point in looking at Europe.
I'm sorry?
Really implies there's no point in looking at Europe. I mean, I find the US always very self-absorbed, but maybe I'm wrong on this.
Yeah. No, I think we are. It is a real challenge.
Right. Oh yeah. As I said, I have tons of questions, but do you want to react to what Karen said and give a bit of your perspective on the comparison between the two jurisdictions?
Yeah, no, I certainly would. And I mean, for me, it's also difficult to assess exactly how supervision is done in the US, and I would be too far away from it to actually judge. But I think there was a general theme that Karen alluded to at the beginning, that typically it needs a crisis to change things. No, that holds for banking supervision. It holds for also other walks of life. And I think certainly what happened in the US last year in March, and also in Switzerland, and there's also reports from the Swiss authority, was a little bit of a wake-up call for everybody to say we need to focus on the effectiveness and the efficiency of supervision, following up upon open findings. Although we started that process, that discussion even earlier, as I said. So the report was commissioned. We understood. I think it's exactly what Karen said, that I think it was absolutely right what was done in the first 10 years of the SSM to kind of have the same methodology to make sure. I mean, we had very different supervisory cultures in Europe when we had to harmonize them. We had to find the right methodology that everybody is applied. And I think this is a great success, but it also made the system relatively complex. So that's why we had to say we need to see what elements do we need, and where also do we have to exercise a bit more judgment exactly in the space of escalating findings sooner. And let me give one example to make that a bit concrete, where we're actually already doing it. So we started in 2019, 2020 to look more closely into banks' exposures to climate and environmental related risks. And that at the time, even though we knew for a long time, of course, that climate change is an issue, but at the time it was an issue that most of the banks had not paid that much attention to. There was also data missing, of course, from the corporate side to assess climate related risks. And then we very closely worked with the banks, formulating supervisory expectations, clearly outlining what we expect from the banks in terms of good risk management systems, in terms of climate-related risk. We did stress test, the banks did their own assessment. And then we gave them clear deadlines as to when do we expect gaps between where they are and what is our expectations. When do we expect these gaps to be remediated? And the final deadline is actually the end of 2024. And that's also where we used for the first time periodic penalty payments, which we have in our toolbox. So it's given to us by the legislator, but it hasn't been used a lot. And one can really see that this moved the needle. So of course, I mean, not everybody on the banking side was entirely happy about this, but I think it also gave the right incentives, and also made clear what we expect. And so a lot of banks have moved. Of course, we're not there yet. So I mean, this will be an issue that will keep coming back. But I think we've by giving a clear timeline, by clearly saying how we would escalate, I think we also improved the risk management. I think it's also then widely acknowledged now that we have made these improvements. And by the way, the periodic penalty payments, they would also be public. So that provides a strong incentives for the banks to remediate before. And of course, it's periodic, so they would not have to pay them once the remediation has happened. But of course, there's an incentive not to go there in the first place and rather meet our expectations. So maybe that's a good example of this escalation that also Karen mentioned.
So there's another example that has been much in the press, and I don't want to put you on the spot by referring to individual institutions, of course, because you cannot comment in public on individual cases. But Eurozone banks that have a large presence in Russia, everybody knows their names. It has been quite visible in the press that the ECB has been putting some moral suasion on them, or maybe more in terms of reducing their presence in Russia or terminating it altogether, but that hasn't led to visible change on the ground. So on this count, can you give us a bit more of a sense of how this part of the pressure or nudging works in your view, and the challenges it poses?
Yeah, so I mean, this is an area, as you said, where I can't go into much detail because I can't, of course, talk about individual banks or decisions that we've taken. But I think this is, again, a very good example of how the risk landscape has changed. So this is clearly related to geopolitical risks. So you can have exposures in countries where also the risks are not coming from the economic side, but of course from the start of the war, the imposition of sanctions. And so we then had to assess, are there risks inherent in the activities of banks in Russia which can have prudential implications? So we are not the sanctions authority, so we're not the ones judging on whether or not there's sanction compliance, to make that very, very clear, or compliance with other regulations. But of course, if you're operating in a difficult environment and you have compliance risk, that can have implications also for your reputation or for fines that you have to face, and that has implications from a prudential point of view. Also, if you're operating in a difficult environment, you have to make sure as a bank that you have the ability to control risks in place, so that you can access the information, that you can have your control functions in place. And we told the banks early on that we see issues there, and that so we asked them to exit and downsize from Russia, and that has happened in many cases, but I can't go into the very details here. Now, I think this also tells us a lesson more broadly, because I think these geopolitical risks, they won't disappear. We have a very different also geopolitical environment, and changes in the international institutional order. So this is now why we are now also working very closely to, let me call it, develop a framework that we can use as supervisors to deal with geopolitical risks, and to understand how these geopolitical risks impact basically all the risk categories that are relevant for the banks: credit risk, market risk, liquidity risk, operational risk. So this is something we work on very closely, and we have many other activities in place. The cyber resilience stress test, for example, that we've done this year, which is addressing this type of risk.
I'd like to go back on the escalation ladder concept that you presented in your slides. On this issue, this, of course, requires a lot of judgment from the supervisor, because the banks will say, we're in Russia, we're making good money, we get good clients, we're safe and sound. Why? Actually, this contributes to the group level safety and soundness. So why do you want us to cut that activity? Does the escalation ladder give you the tools you need to impose your view of the risk in such a judgmental situation? Again, without going into individual cases.
No, sure. I would answer that question generally. I mean, first of all, the escalation ladder is not something that we have invented or made up, but this is basically this includes all the tools that the legislator has given to us, and so we have quite a bit of powers in terms of binding, non-binding requirements that we can implement. So it's nothing that comes from us, but it's something that's given to us by the regulator. And it's clear. I mean, you start. When you have a finding, you do your risk assessment, you have a finding, of course, then you start getting into a supervisory dialogue with the banks to explain where you see problems and whether or not where findings need to be remediated. And as Karen said, I think in many of the cases, the banks already know that they also have issues there, so they will respond, yes, we will deal with this, and you come back to us at some time. But then, of course, as a supervisor, you can't just sit and wait. You also have to give deadlines. You have to require action plans from the banks, and this is basically what we are doing. So we're not erratically, moving up a ladder that we have invented, but we take these different steps in a very organized way, and also, of course, because our decisions in the end, if we have binding requirements, they need to be legally sound, and we follow exactly that process, and so we can't jump over one of these steps, but we do it in a very organized way.
This is a bit of an awkward question for me to ask in the middle of an election cycle in the US, but I think in a way we have a similar thing in the US, even so it's a very domestic banking system, but it also has international activities. And even domestically, we see new types of national security risk, right? And some of them are not really with a precedent in living memory. Is that something that supervisors discuss in the US, or is that completely outside of their radar?
That's a terrific question. I think one of the challenges is people have talked about geopolitical risk. There's, of course, from a national security perspective, there's a lot of attention to money laundering and sanctions compliance. So I do think this is an area certainly of a great deal of discussion and public attention. We've seen some recent fines of significant magnitude. Of course, one would hope that institutions would self-correct or be corrected before they reach the magnitude of some of the recent cases. But that's a top priority, that national security risk. Geopolitical risk has always been a more abstract one. I think the U.S. Bank Supervisory perspective is they're not sure how to deal with it. They really rely on the very largest international institutions to do so through political risk analysis and so forth. But it's a continuing and perfect art, but of course, one where there's significant potential shock. I would add to what Claudia says, another major issue here, we talked a lot about it as non-bank financial intermediaries, the interconnectivity between the banks, particularly the biggest ones, and increasingly leveraged, unsupervised, and higher risk non-banks continues to be a very significant challenge. U.S. bank supervisors have essentially no direct authority over virtually all non-banks. But I think this is a glaring issue we're going to have to deal with in the very near future.
We shift to a different topic, which is technology. We have a question from Stephen Cecchetti asking if supervisors have access to high-frequency information from the banks. Banks have information systems, of course, that gives them, say, daily report on end-of-day position on all kinds of on-balance sheet, off-balance sheet exposures and liabilities. Steve is asking whether European supervisors have been using that kind of information to analyze risk, or do you consider doing that? And I also have a question on, you had a slide, Claudia, on your IT endeavors. I think it was your item number 6 in the reform. And you mentioned a number of fancy tech-sounding names. I wasn't sure. Are these vendors? Are these internal projects? Are these? Can you explain a bit what these names refer to and how you think of your IT and technological transformation with AI and what have you? Claudia.
Okay. Thank you. No, great questions. The first on the how frequently do we get the data and information from the banks? So one area where we really have stepped up efforts also after what happened last year was liquidity reporting. So we now have much more high frequency liquidity reporting from the banks. Initially, of course, there was a little bit of opposition saying that this would increase the reporting burden, but it was very quickly that actually this reporting was coming in, and it's certainly one of the indicators that we continuously monitor now. So we have more frequent liquidity data. With other issues, of course, banks have more information than what we have, and of course we always have to balance out a bit what do we need from them, what do we get. There's also, of course, the issue of reporting burden is a real one, but when we need data, we get the data so that we can conduct our supervision. Let me just say maybe just a quick remark to what Karen said. I agree that addressing geopolitical risk is really difficult, but I think in particular in the space of liquidity risk, we need to be aware that at the current juncture, markets are not fully pricing geopolitical risk. So and then also related to what could potentially happen in the NBFI space or non-bank financial intermediation. I think liquidity risk is really something where we have to have an eye on. So this is not contradicting what you said, but I think complementing it. And then now I forgot the second question that you had. So all this
content number 6, you know, these projects.
Yes. No. These are internal projects and internal project names that we have developed. So it's basically we have a big subtech agenda. So we really thought very early on, where can we use digital tools, IT systems, data analytics to support our supervisors in the spirit of making it, reducing the routine tasks. Because if you just take one example, this is called Heimdall, which is basically helping the supervisors to do the fit and proper application. So this is the vast majority of our decisions is actually in the space of fit and proper. So if somebody wants to become a board member, people have to submit their CVs and a lot of supplementary information to us. And that has to be, first of all, worked with and then also assessed. And so this is where we use machine reading and data analytics to go through these through these applications. I think it also makes it easier for the banks to submit these documents. And there's many other tools which improve data sharing, having a data lake, and also making sure, for example, if you want to assess ownership structures, we have a tool which helps you to do that. So these are all projects that have been developed within the SSM, and then of course they are also rolled out across the national authorities because they can also benefit from using them. Yeah.
So you just mentioned the national authorities, and that's my next question. You mentioned the way national authorities and the ECB work together in the single supervisory mechanism, the SSM. But that has raised a number of questions, and I will ask you about two of these questions. One is the structure of the supervisory board. I mean, the supervisory board, of course, has representatives from the national authorities. That means it has 27 members, formally actually more if you include countries where both the national central bank and the separate supervisor are represented. That's a huge number, and many observers have hinted at the risk of dysfunctional decision in boards at large when you compare with a lot of the international references where you have a much more compact organization. So can you get us a bit of a sense of how the ECB makes it work, or if it doesn't work well, what the challenges are? And separately, but related to that, can you give us a flavor of the what you described as oversight, the supervision of smaller and medium-sized banks, the less significant institutions in the ECB jargon? Many people have understood that as these smaller banks being outside of European banking supervision. I guess you will explain to us why that's not the case, but can you give us a bit of a more granular feeling of how that works and also how it has evolved over time, maybe?
Okay, no, thank you very much. Again, these are great questions. So basically, if you want to think about the composition of the supervisory board, it's basically the same composition as another ECB decision-making body. So the governing council, of course, there you also have the countries represented, the euro area countries being represented, and that's the same in the supervisory board. And I would say that as far as I have observed the decision-making process now, and also being in charge of organizing the decision-making process now for this year, I would say that it's really the decisions are taken in a common European spirit. Of course, they're being prepared by the staff here in the building. They're being prepared also the different networks and working groups where, again, also the national authorities sit around the table. They've seen, of course, the preparation of this before. And then when it comes to the table, of course, we have discussions like in any other body where decisions have to be taken. We have discussions on pros and cons of different options. And of course, people bring also their national experience and expertise to the table. But I think in the end, we always come to good decisions, and they're also taken in a European spirit. So I would not agree to what has been said, that this is dysfunctional. Of course, it's many people around the table, but I think in in many decision-making bodies in Europe, we have many people around the table, and maybe I'm slightly more optimistic also given where I am here, that Europe is working, that the SSM is working, and also our decision-making bodies are working. But of course, it needs time. It also needs communication beforehand, so that and it needs the common standards that I've been talking about before, so that everybody works within the same framework. And I think here the SSM, I mean, this is not to my credit, but it's to the credit of the staff here and my predecessors, Daniel Nui and Andrea and Ria. They've really built up a very good infrastructure here. Coming to the oversight function, yes, as I've been describing, so the SSM and the decisions in the supervisory board, they affect directly the significant institutions. So there's a size threshold. It's the 3 largest banks in each country that are under the direct supervision of the ECB, and then also for efficiency reasons, practically the smaller, the less significant institutions, they're directly supervised by the national authorities. But of course, this also happens in the same framework. So they have to meet the same, they work under the same regulatory regime as the supervision in the ECB. Our oversight function means that we also, of course, have information about these less significant institutions. We also do benchmarking. And if we would see major deficiencies in that area, then we could also take direct supervision over the less significant institutions, so which is typically not needed.
Have there been examples of you doing that, taking direct supervision over a small bank from a national supervisor because you felt it was not going perfect?
I would have. I'm not aware of that, but maybe I don't know if that has happened at the beginning of the SSM at some point. I don't know, but no, I think in most of the cases we also understand very well what's happening in the space of the less significant institutions. And as I said, we also do benchmarking, and we have discussions about how we do how supervision is being done there. And many national authorities actually also use the tools that we have developed for the significant institutions and apply them in their space to the extent that it fits, of course. I should also say that all the licensing procedures are going through us, of course, again, in collaboration with the national authorities. So that's why we know quite well also what's going on in that space.
Aaron, I'd like to go back to one thing that is at a fairly fundamental level. Claudia emphasized a lot the discretion that the supervisor has, and what the jargon calls Pillar 2, right, in the Basel language, the fact that supervisors apply judgment and they're not just enforcing the rules in a narrow way. They have to take a holistic approach to risk. You told us that there hadn't been enough of that in the US, and that was something revealed by last year's episode. This looks like a pretty fundamental feature of the US framework. Indeed, the US authorities, unless I'm mistaken, have always expressed some caution about formalizing their Pillar 2 authority. Can you give us a sense of why is the US so reluctant about Pillar 2 and how that may evolve in the future?
It's a really important question. I think you would find the agencies say that they aren't reluctant about Pillar 2, that they exercise supervisory judgment by virtue of the supervisory oversight regime. But there's always been a real challenge between supervisors and discretion, and bankers, and particularly, I hate to say it, bank lawyers who love certainty. And we've unfortunately, at least in the United States, we've gone to a much more rule-based system. And again, you saw that in 2023, where each of the institutions, and for that matter, I believe in the EU, where Credit Suisse, they checked all the boxes on capital and liquidity rules. They just happened to be profoundly fragile entities. And one of the reasons I've argued so forcefully for more nimble supervision that focuses on high priority issues is not because I think we need to have more codification of Pillar 2. I just think we need to have much better exercise of judgment over, if necessary, Pillar 1, and then the often more subjective and qualitative indicia of meaningful noncompliance, not numerical adherence.
Is it possible in the US? You mentioned the lawyers, right? I mean, it's such a litigated culture or environment. At the end of the day, is it possible for supervisors to have the discretion they should have given this context?
Yes, I mean, right now they have enormous discretion to do nothing. I mean, that's really the problem we have. There's enormous discretion, but it's a raised lowest common denominator construct as opposed to a system in which encourages action and then intervenes when it goes too far.
Right. That's a bit scary. We're almost at the hour, but I want to ask 2 more questions to you, Claudia. One is a question that is raised by Claude Chart. It's not really in your department as a supervisor, but you led a group at the Financial Stability Board, if I remember, that looked at the resolution practices. So Court is asking, are the reforms of resolution and, the key attributes of the Financial Stability Board and so on, are they up to it, or is the lesson of recent episodes that this has to be rethought? I'll ask you for a very brief answer to this one. And another question I'd like to ask before we part is something that Karen kind of provoked you on indirectly by calling from the public disclosure of CAMEL scores in the US. Of course, the ECB has the equivalent, which is SREP scores. Would it be thinkable to disclose SREP scores?
Well, thank you. Interesting questions. So quickly on the first one. So, I mean, there's actually an interesting and important debate in Europe right now on how we can make the resolution regime more effective. So that comes with an acronym, CMDI, Crisis Management and Deposit Insurance. And we've always been arguing that it's extremely important to have credible resolution because it eases the job of the supervisor. So only if I know that if a bank is failing or likely to fail, then there's somebody dealing with it in a credible way. Only then I can really, exercise all my supervisory powers that we've been talking about. So we've been also opining on this reform that if it makes a resolution more credible in the sense that if more entities are moved under the resolution framework, then also the funding for that needs to be there. We also need the sufficiently workable early intervention powers, which we now have. So we shouldn't have a reform which makes it more difficult to intervene preventively. So these are all things that I think are on the agenda, and we need to see. So there's a Commission proposal. Maybe that's for another session here. So it's a complex issue. There's a Commission proposal now, a Council proposal, and we really hope that the whole package is going into the right direction. Let me put it this way. In terms of transparency, I mean, this was clearly one of the main items on the agenda of my predecessor Andrea and Ria, and I'm fully committed to be transparent about what we do in terms of methodology, also disclosing information that we need to disclose that make it easier for the market to assess what is ongoing. But of course, the details we have to discuss. So I wouldn't have a strong view on this at this point in time.
Maybe to finish, Karen, there's a question from Jean-Christophe Perrin about the Trump issue. We're in the I'm currently in the US, so and so is the Peterson Institute. So I guess I cannot escape this. Jean-Christophe is saying that Trump defunded, that's his word, a number of agencies during his first mandate. So the question is basically the risk to the effectiveness of banking supervision if he gets another shot at it. How do you view that? How did the U.S. supervision, how was it affected by the Trump administration, if at all? And what do you see that as a risk? Karen? It seems we have a technical issue at a moment that doesn't give us much time to address it. So it will remain a question with no answer, which maybe is appropriate. Okay, so that will be it for today. I want to be particularly grateful to our two speakers. Karen is no longer on the screen to reciprocate, but Claudia, I'm extremely grateful for you taking the time. We know how busy you are to address all these questions and give us a sense of how European banking supervision is evolving. And that will be it for the season. We'll make a short pause during the summer in the series, and we'll start again probably in late August. That will be, of course, properly communicated. In the meantime, great summer to everybody. And thanks again to you, Claudia, and to Karen in absentia for a very illuminating session.
Thank you very much. A nice summer also from my side. Thank you.